Hello, ladies and gentlemen, and welcome to Accounting in Motion, presented by me and Parth. Today, we're going to be talking about intangible capital assets. So it's a very interesting topic. It's also quite extensive, so stick with us and be sure to task. So what are intangible assets? So something is intangible when it cannot be held or felt. Things like the internet or websites that cannot be physically felt or touched. These things are called intangibles. An intangible asset, therefore, is an asset that is not physical in nature. Now, we've been talking about things that are physical, things like property, plant, and equipment. These are all tangible assets. Now, we're going to go into intangible assets. Now, intangible assets can be both limited in their useful life or unlimited in their useful lives. So, in the case of unlimited ones, we don't amortize for them. Now we're going to go into a bit more detail in that later on. So these assets are similar to tangible assets in that they both benefit future periods and are used to produce products or provide services over these periods. So they both produce revenue for the company and they both help company make money. So things like patents, trademarks, copyrights, business methodologies, goodwill, and brand recognition are all common intangible assets in today's marketplace. Now we're going to go into a bit more detail in each one of them a bit later on, so stick with us. Now, very important, they are amortized on a straight line basis. We don't use declining method, we don't use any other method, we use straight line amortization to amortize intangible assets.
Patents is one of the many intangible assets that we will be covering in the video. So what are patents? They are exclusive rights that are issued by the Canadian Intellectual Property Office. What do they do? Well, they enable the recipient to manufacture, sell, and control an invention for a period of 20 years from the date of application. You can renew them, and their legal life can only be extended if the recipient obtains new patents for improvements. The initial cost of a patent is the cash or the cash paid to acquire it. The cost must be amortized over its 20-year legal life or its useful life, whichever is shorter. The basic journal entry that goes with it is you debit an amortization expense and you credit the asset itself. Before, when you used to amortize, you always debited the amortization expense and credited the accumulated amortization. However, for intangible assets, you always credit the asset.
So let's do an example for patents. So let's say Rob Ford Company buys a patent for $50,000, estimating its useful life to be 5 years. What will be the initial journal entry and what will be the amortization after the first year? Now I want you to pause the video and do this yourself to see if you can do it. So now that hopefully you've done it, let's see if you got it right. So first of all, you would debit patents for $50,000 and you would credit cash. So you paid basically $50,000 to purchase a patent. Pretty straightforward. Now here comes a bit of a tricky part. Amortization expense for $10,000 is debited, which is normal, but the patent itself is credited for $10,000 instead of an accumulated amortization accounts, which is what we would usually credit. And so that's very important. For the annual amortization entry, credit the asset account directly for all intangible assets, patents, copyrights, trademarks. All of them are going to follow this pattern. So very important to remember.
Copyrights. Copyrights gives the owner an exclusive right to reproduce and sell an artistic or published work. They extend for the life of the creator plus 50 years. Generally, the useful life of a copyright is significantly shorter than its legal life, which means when you amortize it, you will use the useful life because it is shorter than the legal life. Its cost consists of the cost of acquiring and defending it. The cost may only be the fee paid to register the copyright. It may also amount to a great deal more if a copyright infringement suit is involved. The amortization for this is done the same way as for any other intangible assets.
So now let's talk about trademarks and trade names. A trademark, also known as a trade name, is a word, phrase, jingle, or symbol that identifies a particular enterprise or product. So things that represent a company could be an example of this.
Now, some actual examples are "Just Do It," a slogan used by Nike; the Camry, a car produced by Toyota; and of course, the Pepsi symbol, which is universally used to recognize the soft drink manufacturer. Now, they really enhance the sale of the product. So to be able to get exclusive rights for a trademark, the creator has to register that trademark with the Canadian Intellectual Property Office. It is renewed every 15 years, but this is only as long as a trademark or trade name is in use. Now, most companies realistically will keep on renewing their trademark, even if it is not in use, leading to really having an infinite useful life. And like I said before, intangible assets with indefinite useful lives are not amortized. Now, if it is purchased, then the cost of the trademark or trade name is the purchase price. Pretty straightforward. But if it is developed internally rather than purchased, the cost includes a lot of things like legal fees, registration fees, design costs, successful legal defense costs, and other expenditures directly related to securing that trademark.
Abdullah, can you tell me a good fun fact?
Sure, Parth. Did you know that the new BP logo that's pictured that replaced its old one is considered to be one of the most expensive corporate logos in the world?
No way.
Yeah, it cost about $211 million.
That's more than my house.
Yeah, man. In comparison, the Nike swoosh logo cost about $35 when it was made in 1971.
You gotta be kidding me. Franchises and licenses. So I hope I know all you guys have heard about Burger King, McDonald's, and Starbucks, and all of that. They all fall under this category. A franchise is a contractual arrangement between a franchisor and a franchisee. A franchisor gives the franchisee permission to sell their products, offer specific service, or use certain trademarks or trade names. Another type of franchise, a contract between a government body and a company. This franchise permits the company to use public property in performing its service. For example, Brampton Transit or any other taxi services that you see around Brampton or anywhere else. They all fall under this category. And these operating rights are referred to as licenses. The cost of a franchise license should be amortized over the useful life. If it's indefinite means that you cannot amortize it, it doesn't have a useful or legal life. You can use it for as long as you want. It must be tested annually for impairment and written down if required. Annual payments are sometimes required under a franchise agreement known as royalties. These are recorded as operating expenses in the period in which they are incurred, which follows the matching principle under GAAP.
So let's move on now to goodwill. Now, it is usually the largest asset on a balance sheet. That's very important to remember. That being said, what is goodwill? Well, it is the value of attributes that relate to a business enterprise. This includes such qualities as exceptional management, a desirable location, relating to, I'm sure you've heard the phrase location, location, location. Good customer relations, also very important. Skilled employees, essential to a business. And of course, high quality products and relations with labor unions. All of these things are valuable. Goodwill is only recorded when there is a purchase of an entire business. Now, this is the only time you're going to be recording goodwill. But how do you record goodwill? So, it is the excess of cost or the fair market value of the net assets acquired. Now, how do you recognize it? So, basically, net assets are debited at their fair market value, cash is credited for the purchase price, and goodwill is debited for the difference.
Research and development costs, also known as R&D. They are not intangible assets. Make sure you remember this. The reason we discuss it is because they might lead to patents or copyrights. Many companies spend a lot of money on research and development R&D. For instance, recently, Nortel Network spent nearly $3 billion on R&D, which is quite a lot of money. R&D present two accounting problems. The first one is, it is sometimes difficult to determine the cost for specific projects. And the second one is, it is also hard to know the extent and timing of future benefits. All R&D costs should be expensed when incurred. which we know it follows matching principle again. Certain development costs with reasonably assured future benefits can be capitalized. Nonetheless, this approach is considered highly speculative.
And that, guys, is all. So by now, you should know what intangible assets are. Be able to tell the difference between tangible and intangible assets. Know what patents, trademarks, copyrights, goodwill, research and development, as well as franchises and licenses are. All those things you need to know. And be able to record and amortize for each. Now keep in mind, some of them are not amortized. And as always, keep calm and continue journalizing.